Well, it's supposed to pass through. I think I know most everybody here, but there's a couple here that I don't. My name's Doug Reeder. I'm the chairman and one of the founding partners here at Sterling Seacrest Partners. For those who don't know us well, we're a multidisciplinary commercial insurance agency with deep industry verticals across a number of industry groups, including healthcare, construction, real estate and hospitality, transportation and logistics, nonprofits, and we also have a growing private client team. So we also offer all forms of personal insurance to our business owners and other professionals and sort of the upper tier of the personal lines market. If you ever want to take a look or drill down into that, my partner who runs that group does a great job of identifying and helping you correct for gaps in your personal insurance, which many times entrepreneurs sort of take that for granted and set it aside and work with somebody they met at the storefront or Rotary Club, and they don't look at it, and we get involved, and there are gigantic gaps in coverage because of the person's success on the business side. So we can help with that. If we can ever be a resource, let us know. We also have a large team of employee benefits specialists who consult with folks on the structuring, the product mix, and the resources associated with administering employee benefit plans, so health insurance, long-term disability, life insurance, et cetera. And that tends to be agnostic, so that's just driven by the number of enrollees, and we kind of target the 50 plus enrolled space, and it's about 25% of our business. It's gotten highly complicated with the advent of ACA and all the changes in health insurance the last 10 years. So it's much more complicated than it used to be, and we have a great group of folks that can help you maneuver through that. We welcome you, appreciate you making time to come through the rain and get here in person. We really value our clients and our friends' participation in this program. We've been doing this now for 4 or 5 years, and it's really kind of become a differentiator and a vital part of our value proposition to our friends in the business. And we're really pleased to have David Adams here with us this morning to speak. This program came out of a conversation that David and I had a few months ago, where we talked a lot about all the business transition that is occurring. Just demographically, there is it's no secret that the baby boom generation is sort of aging out as we speak, and so that's a lot of the business owners that we deal with happen to have been born during the baby boom. And so there's a lot of this going on, and we have had a number of programs over the last couple of years that focus on the various aspects of this, and what David does is a key element of this. So we're really pleased to have him out here to talk about business appraisal and the kind of value that they can help you identify and improve upon. David's firm provides independent third-party business valuation, expertise, and consulting for decision makers of all types, including board members, shareholders, and management. Adams Capital Services facilitates mergers, acquisitions, fairness opinions, Sarbanes-Oxley compliance, buy-sell agreements, so internal perpetuation plans, incentive compensation, and profit enhancement efforts. Please welcome David Adams.
Thank you, Doug. And so this morning, ask questions. I'd like to make it interactive. We're going to have a little bit of fun and talk about, in general, business, but practices that are just a good idea. So this is all stuff you should know, but I want you to leave here a more educated decision maker. And that's really the point of business valuation, is to help you make better decisions. So I'll give you an example of, well, first, we're not about transactions. Selling a business, not selling a business, doesn't matter. This is about running a better business. And you know what? better businesses sell faster and for higher amounts of money. So better businesses are easier to run, they make more money, and that's why buyers want them. So just be a better business. It's not about selling. It's not about a transaction. And if you're thinking about transitioning to the next generation coworkers, next generation kids, grandkids, a better business is easier to transfer. It's easier for them to run. It's easier for them to be successful in. So we really have a nice opportunity to create value. And that's about me. Anybody who wants these slides, I'll share my contact information, and I'm happy to email them to you. So closely held family businesses, 6 million of them just in the U.S. Most will transition in the next 10 years, and that's just what Doug was referring to. It's demographics. And but the probability of success, and by success I mean getting what you want, having it work out, maybe 10%. So most of these businesses will fail to transition. In other words, you're not going to get the price you expect. You know, if you're a seller, all you can really do is put up a for sale sign. You have no control over the purchase price. You have no control over the financing that the buyer may need to have to acquire your business. All you can do is just sort of be there. You are entirely dependent on a buyer. And a buyer, as soon as you sign that letter of intent, you've basically turned over all control of the process. At that point, your only power is just to say no. But so there's a whole lot to be aware of before you get to that letter of intent. And so success, current written plans communicated with the team in a way that can be readily executed. So I'm guessing if we go around the room, only 20% of you all have current wills, any kind of written business transition plan if you're getting an accident, or any kind of who's going to take over, what they're going to do. You might have it in your mind, but it's not written down. You haven't communicated to the people that need to take action in your absence. And I used to be a scout leader, and my scout leader job was to help scouts, Life Scouts, become Eagle Scouts. And I worked on these Eagle Scout projects. And if a 13-year-old kid can write down a business plan that anybody else can follow and build that scout project, you guys can. Okay? It's not that hard. Eagle Scouts have been doing it for years, but there are not that many Eagle Scouts. But that's the kind of thinking that it takes to have this current written plan. All right. So why be concerned about value measurement? Again, just being an informed decision maker. Partner buyout, shareholder buyout, incentive compensation, exit pricing, capital raising, and then divorce is the biggest wealth destruction thing going on for entrepreneurs. But half is worth less than 50%. Personal goodwill is an issue. And what I mean by that is your employees go home every day. If you don't have employment agreements with them and they go to a competitor, that's the kind of thing that's personal goodwill. That's an asset of yours while they're at your business, but when they leave, it's gone. Well, the one time in an entrepreneur's life when they have a non-compete agreement or employment agreement is the day they sell. Up until then, you don't have that your own personal goodwill is really not part of the company. Our financial statements are misleading because they capture all your personal goodwill, the revenue you generate in the business, but it's not really owned by the business. So something to be thinking of. And value in cash, very different. It's hard to get cash for the value of the business. financing is, let's just assume it's probably not available. And if you have debt, it's maybe a good idea before you sell to pay that off. You're going to have to sell it you're going to have to pay it off in a transaction anyway. But you can work towards building equity by paying off your debt. And it also, again, makes it an easier business to run with no debt. Yes, Hunter?
It seems to be one of the biggest challenges I think about in life is I'm 55, and I think about the future of our business, and I think, well, what's the best way? Is it going to be, in terms of succession and transition, is it going to be one of my two boys? I don't know that yet. Is it going to be somebody in our firm? I don't know that yet. Is it going to be a sale to a third party? So, when someone like has say a 10-year window or 10 or 15-year sort of horizon that really needs to talk about putting something on paper, I agree with you. But right now, if I had to sort of say how that would look, I couldn't tell you how that is going to look.
So the question for our online friends is about transition. If I don't know, if it's a 10-year window and I don't know how, whether it's kids or coworkers or who it's going to or some third party who it's going to transition to, what do I do? It's just run a better business, and then it keeps all your options open. You don't have to know who your buyer is. I think that from a valuation perspective, that just it's now there are other perspectives. One of the things I've learned in providing helping our clients become informed decision makers is one guy I was sitting with, and we're evaluating this transaction. He had an offer of $20 million for this business, and he was already wealthy, so it really wasn't about the money to him at all. 20 million's a lot of money, but we ran the numbers, and I'm looking at it like, well, I think this business is worth more like $80 million. And we walked through and talked to him about why it was worth $80 million. He says, okay, good. And then he sold it for $20 million. And I asked him why. And he said, well, I didn't need the money. I was tired, and I just was ready to move on. So again, money is not necessarily the motivator for everything. And I've seen a lot of family-owned businesses stay in the family. It's not for money. It's just what they've decided to do. I've seen a lot of business owners sell to employees because they knew any other acquirer would close that facility and consolidate all the people, and they wanted to support the local community and keep the business operating there. So a lot of factors that go into the decision of what to do that are non-monetary. So our top 10 topics, income approach, market approach, asset approach. These are just ways to measure value. I want to make sure you're informed about these. There are really only three things that drive value: profitability, risk, and growth. I'm going to go through those. And then potential buyers. These are, ultimately the ones that set the market price. And then key people, personal goodwill. I already mentioned that a little bit, but I want to make sure you all are aware of how to capture. You want to convert personal goodwill into corporate goodwill. Lack of marketability, lack of control. These are topics that basically we're all private businesses are not marketable. I mean, you have to go through this big process and agonize, but the New York Stock Exchange companies are. And then control, either you have it or you don't, and we'll go through that. But people will pay for control. So the valuation approaches, income, market, and asset. These are the only three. You may hear in the valuation industry about 8 or 10 approaches. It's all variations of these three. Assets is real easy. It's what does it take to start the business, greenfield, and hire all the people, just start from scratch. And that's a good number to know, because a buyer could always just start a competing business. So that it's your business is worth maybe at least that much, but anything over that, you're going to have to work for. And that gets into the income approach, which is our cash flow. It's what we have at the end of the year after paying all the bills, and we pay tax on that. And really, it's the cash flow after tax that is most valuable to me. I don't know about you guys, but I've had trouble spending my before tax money, and I've had trouble spending my before interest money. So you've heard maybe this earnings before interest, taxes, depreciation, and amortization, EBITDA. A lot of businesses, there's talk about selling for multiples of EBITDA. But in the real world, that you can't spend EBITDA. You can spend cash after tax. So income approach, we want to just be informed about what kind of income we're looking at. Is it that EBITDA sort of fantasy number, or is it my cash after tax? And then market approach. It's what other businesses have sold for. And even though they're probably larger, but public stock exchange transactions can be great benchmarks. If the industry competitors, even though much larger than you, are going down in value, that's a sign. If they're going up in value, that's a sign. If the analysts are saying, well, they've done well, but they're not expected to continue to do well, margins are compressing, these are, then this is something that, if you will, adverse information that you're going to need to deal with. If you're talking about selling to a third party, you got to convince them that we're special, we're different, we have different customers, we have, but there's a story. You need to be aware of where the buyers are, their perspective, so you can be an educated seller and tell your story. Tell how you're different, how in the last downturn, how you managed to get through it, and what's your secret sauce. But it's really an opportunity to sell. It's not a negative. You can always turn a negative into an opportunity. These, let's see, and only two ways to make money: annual cash flow and sale of the business. So that's it. That's all we're measuring when we come to value, do an appraisal. It's annual cash flow and ultimately a sale of the business. So our key value drivers: profitability, risk, and growth. Obviously, we want more profit, we want less risk, and we want more growth. Pretty simple. You can benchmark all your businesses against these three metrics, but the one that we can probably do the most on, I'm guessing you're already focused on profitability, you're already focused on growth. Risk is our big opportunity. Minimizing the risk. And what I want to help you understand, if I'm a buyer, everything in your business is a risk. You are key people, you're a risk. Your employees may quit, they're a risk. Your customers may leave you, they're a risk. Their suppliers, the favorable contracts you've got, whatever you've got, it's all a risk. So how do you make the buyer comfortable with all those risks? And written agreements is a great first step. Employment agreements that are fresh, not 20 years old. Good records. If I'm a buyer and I ask, well, what's your revenue been with this client for the last 10 years? And you could say, oh, here you go, here's the report. Immediately, I'm more comfortable that you're on top of it. But if the answer is, well, we changed accounting systems and I'd have to go back to the warehouse, I maybe could get 3 or 4 years, but I don't really know past that. Not as good an answer. That may be the right, that might you might have really changed accounting systems, and you might not have fed back in the old data. And that's just one of those stories that you need to turn into a, yeah, but we really like the new system. We can fire up the old system if we need to, have an answer. Might not be positive, or as positive. So, yes.
What about deferred comp benefits and supplemental things that tie key employees to the business from a long-term comp standpoint? If you're a buyer, is that attractive to you if those plans are in place ahead of time?
So the question is, if you're a buyer, deferred compensation plan's attractive. Yeah, if I'm a buyer, I'm focused on this risk. I'm worried that all employees are going to quit as soon as I buy the company. So if their employment agreements, long-term incentive compensation plans, golden handcuffs, any kind of things that bind people to the business. In fact, one of the things that buyers love to see is that you've anticipated a transaction, and if you have a change in control provision in the employment agreements where they get some kicker if they stay a year or 2 years, some extra bonus, 20% of their comp or something, or more, then as a buyer, I'm like, oh, good. Well, I feel like that team is going to stay together. And now, as the buyer is going to think, well, the seller has taken on that obligation to keep the team in place, and you only have to pay for the people who stay. Yes, Skip.
So just real quick on the risk management piece on that, we do at our law firm, employment is a big aspect of it. And on the deferred comp piece, probably the third most common mistake I see is particularly post-change of control employment agreements that only treat the non-compete piece as retention. There's an entirely different set of law that relates to the forfeiture of already earned compensation. And 80% of the post-change of control employment agreements we see are great on the new non-compete stuff. They're weak on the forfeiture stuff, just FYI. So in terms of managing risk, having good kick the tires on those agreements, on that piece, I think is very valuable.
So another risk is basically good legal work or poor legal work, and your buyers are going to assess the quality of the legal documents that you have in place, and if it's sloppy, then it makes your whole operation look sloppy from a buyer perspective. And buyers, let's just say, I'm not just looking at one business to buy, I'm looking at 10. And I'm going to buy my favorite of the 10. And my favorite is going to be the one that's best run at the lowest price. Okay. So I'm not, as a sophisticated buyer, I'm going to come into the market and play the market. I'm going to shop. And you want to come out to be that favorite, that one that's got attractive financial characteristics, very nice price, on it management team, and then I might say, everybody else is kind of average, and then there's one that's above average, and we all want to buy the above average, the good looking one. All right, profitability. It's pretty obvious, but here. On closely held businesses, owner discretionary income is the thing. And I'm not saying get rid of the hunting lodge or get rid of your truck or get rid of all the personal, Georgia tickets or whatever. But I want you to start, maybe open a separate business account, have a separate credit card, segregate these costs, make it crystal clear. So when I come in as a buyer, I can absolutely tell what our owner costs versus everybody else's costs. If it's blended, that's all in one pot, you've just made it more complex. Now, you're going to have a story to tell about why you need the UGA season tickets. And, you know, you're just going to have these tales to tell. That's okay. Don't sweat that. But if you got kids on the payroll and hadn't been to the office in a couple of years, you know, separate account. I mean, just account for it. You don't have to change that. It's an easy discussion to have with the buyer. But
I kind of expect you to have some of that.
it's expected. Yeah, don't be afraid of it. Categorize it. Keep great records, and that'll go well. And here, know where your peers are. I see the businesses that are, hey, we're doing great. We're growing at 7% a year. And then we'll come back and say, you know, do you realize your industry is growing 10% a year? Yeah, so you're shrinking. That's what being aware of the rest of the market can be very helpful. Risk. Again, this terrifies buyers, and it should terrify all of us business owners, but we're used to it. We're immune. We don't really understand that every day we show up to work that there are all these risks that we're dealing with. We can have contracts with customers, even if they're not, you feel like you don't need them. Now, obviously, if you're Walmart or McDonald's, customer contract just isn't part of the equation. But if you've got customers that if we buy from you, we'll buy at this price, that may be better than no agreement at all. But technology, this is something that's frequently not. Entrepreneurs will use a lot of technology, have self-created technology, have business processes and all kinds of positive things that are valuable to the business, but they're not well documented. They're not legally captured in the business. A buyer will find this out, and you can either look good or not good. Financial risk, can you manage it through hedging, lines of credit? Have an audit. An audit will probably pay for itself 10, 20, 30 times over in a transaction. And furthermore, one of the areas that we spend a lot of time with post-transaction when they go bad is arguing about working capital. It's how much cash were you supposed to leave in, how much accounts receivable were really there and could be collected, and what bills needed to be paid, not paid. If you have an audit, we can define what working capital is throughout the entire process, and that unhappiness from a buyer's perspective just goes away. It's the buyer's problem. You don't need to worry about it if you have an audit. Well, let me say, if you have an audit and you have a good legal agreement and you follow all the rules, then you don't need to worry about it. But you do need to be well advised to avoid that post-closing agony. Legal risks. We don't see the legal risks really as business owners until, we have to renew our insurance policy and the rates have skyrocketed. Why is that? Well, somebody else in the industry had a problem. Not our problem, but yet we end up paying for it. These are the kind of things buyers are concerned about. And anything we can do to mitigate those risks, safety training, those kind of things really can be very helpful. I think y'all get it. I'm happy to answer any questions about that, but for time, I'm going to move on. Growth. This is the really big thing buyers will pay for. Buyers love growth. And then you need to kind of look at, well, where's the growth coming from? New products, new customers, or geography? There's basically 3 different areas you can grow. And if you can forecast your growth, you're even better. So what I mean by that is, well, for every 3 salespeople we hire, we're going to grow our revenue, $1 million. And we can train salespeople 3 per quarter or 1 a month. And we've got a machine, and we keep hiring them, and we keep adding to revenue. If you can, tie your revenue growth to that kind of mechanism, then they'll pay for it more than, well, the phone rang and we got this new big client and we had this one-time growth, but we don't know if we'll repeat it next year. Margin improvement is also, how efficiently are we running the business? And if you've been growing and are expected to continue to grow, that's really what a buyer is looking at. If we hadn't grown at all, but now we're going to sell and we're going to tell in the buyer we're going to grow 20% a year when we've had 3% growth, that they're not going to buy it. You are selling a 3% growth business no matter, and you just look foolish. It's just not reasonable. If you're really going to grow 20% a year, you should do the growth for a few years and then sell the history of success. Potential buyers, 2 types, strategic and financial. And I might even add for this group, there's a 3rd type. There's the internal buyer, which could be existing employees or family. And sometimes the family and the existing employees is a little less of a sale, more of a gift. You obviously have to be somewhat charitable to make that decision, but that's possible.
Put ESOP in that bucket.
ESOP would be, employees, not necessarily charitable. ESOP it can be magical for about 1% of businesses. And for 99%, it can be a disaster and very expensive mistake. So be careful when evaluating an ESOP. But all the ESOP rules are basically, it's a tax, legal tax dodge for the seller. The name employee stock ownership plan is a misnomer. It's really all the tax benefit goes to the seller. So, and it's good for the employees. I'm not saying anything bad, but it's really about the seller. And when those work, it's really pretty awesome.
What are the things that keep them from working?
I've
never heard that 1% success, and I've heard it, the other way.
Well, let's just, of all the businesses, very few are ESOPs.
Right.
Okay, so my 1% is
It's not
like
success, fail.
No. Most people just decide not to be an ESOP. But reasons to avoid being an ESOP, it's if you think the value of the business is going to go down in the next 5 or 10 years, an ESOP could really be a problem. If you've got an older workforce, ESOP may not be the way to go. If if you don't have enough payroll, ESOP may not be the way to go. In other words, if you look at your payroll and their, let's say it's $1 million a month payroll, but $300,000 a month goes to 2 people. That maybe is not as good an ESOP company as $1 million a month, and we got it spread equally among almost the whole team. So payroll is a driver. I'm not an ESOP guru. There are people, you definitely need legal counsel on that. There are ESOP gurus who are professionals and will evaluate whether you can be an ESOP. But you need financing to do an ESOP. And if the bank won't loan the money, then you're the bank. And sometimes that's a deal killer because a lot of sellers want their cash, and that ESOP really can't pay cash. They have to borrow the money. So strategic buyers, they're in your business. Financial buyers, right now, it's a lot of private equity running around they're historically, financial buyers were the low bidder, and strategic buyers were the high bidder. It's flipped now. The financial buyers are almost always now the high bidder, and the strategics are not able to compete on price for transactions. And let me caveat that a little bit more. The financial buyers are looking for larger businesses. Earnings of $10 million plus is really where they get excited about $10 million plus. Anything below $10 million, that's maybe not a platform company that they would look at, but maybe a bolt-on acquisition. So now you're moving. It might be a financial sponsor, but you're more strategic to them, and the pricing's going to go down. So as you get under 10 million, the pricing goes down. Yes.
Sorry, I keep peppering you with questions, but you hear a lot of times people say, "Well, I don't really want to sell the business entirely, and I just want to take some chips off." Feel really good about the business long term. I want to participate in the growth of the business, but at the same time, I want to get some chips off the table and kind of enjoy my lifestyle. What do you see people do? What strategies, what techniques, what mechanisms do they use to do that?
Yeah. So the question is taking chips off the table, and what mechanisms and strategies do we see? They're basically, I think in general, that can be a really good idea because you can get some outside capital. If you're at a point where, gosh, I'd like to double down and really grow this business, but at my age, I need to, the prudent thing for me to do is take some chips off the table and plan for retirement. That's a great opportunity to bring in some third-party money. And there are two types of third-party money that can come in. One is a minority stakeholder, and the other is basically they'll take full control. And you can shop either one, and there are opportunities to, but they're both going to look for a pretty strong management team. So if you're a solo manager, that's probably not realistic. You can sell the whole business, but if you're a solo manager, solo entrepreneur with a team that's not really able to take over the business, your value is low. You really, what buyers want is a team that can continue to run and perpetuate the business. So, but you can find even in all these control takeover transactions that the owners can keep at 10-20% of the business and have if you will, a second bite at the apple. So
that's pretty common in the financial buyer world.
The financial buyers like the owners to continue to have a financial stake in long-term success. Yeah. So I always think you want to. Everybody wins that way.
Who are the participants? And I'm familiar with a situation we're working with where they've got like a family office that's a stakeholder in the business, and it's got a longer term perspective. I mean, who are the candidates for minority ownership takeout? Where you're taking just chips out, but the operator's still the controlling shareholder or the operators. Is that
so? Who are the candidates for minority investment?
Because usually, the financial guys, they want to turn in 5 years, and it's
Well, okay. First off, let's all admit that we're great at doing our core business, but we're not great. We've never sold a business. Or if we've done it, if we sold one, it's 10, 20 years ago, and they're pros. Find an investment banker and tell them, hey, I just want to sell a minority stake. Here's, I want to take some chips off the table, but I got this great opportunity to grow. And an investment banker, that's their job. They'll go do that, and they'll line up, 20 investors who want that minority stake. So, but to think you can do it as an entrepreneur and find that magical buyer who'll do just everything for you, you're probably leaving money on the table. You may be getting into a deal that you're going to regret. I want to see you get a partner who can help you with the business. So just money isn't good enough. You want money and talent. And if you just need money, go to the bank and borrow it. If you're giving up equity, you want talent to go with it. You want somebody who can step in if you get in trouble and bail you out. That's basically one of the things I would look for. All right, key people and personal goodwill. This is a real good test of, is your business saleable because you've got a great management team, or is it not as saleable because you're the one that everybody comes to make any kind of decision? Can you take a 4-week vacation, not check email, not make phone calls? If you can do this, then you've got a pretty good business. You've got a nice management team. And the longer the better. And if you can't do this now, plan for it. Take a 2-week vacation, delegate the responsibility, and see who steps up. If they don't step up, if they can't do it, then you need different people. But you can make your business more valuable, and it's really shed a lot of things that you. How many of y'all entrepreneur business owners, or how many people are here are business, work private business? So yeah, so all right. Everything you do all day, every day is something you love to do. How many? Yeah. That's stuff that you're doing during the day that you don't love to do. You can delegate to somebody else who, believe it or not, will love to do it. There are people in the world who can't wait to, do the financial statements. They can't wait to do the legal work. They can't wait to do the human resources planning and such. Get those people on your team and delegate that stuff you don't like doing to them. And then if you prefer spending your time with customers, golfing, what have you, then do those things you love. My guess is the whole business will do better. Buyers are going to look at the management and succession planning, ages of the team. Is there a succession plan in place? Now, this is interesting. We're thinking succession plan as something you do until you have a buyer, but the buyer is just as interested, maybe even more interested in how well you planned. And I already talked about the buyers are just terrified about everything. They are once they find a business and they're interested in it, now they're looking for a reason to not buy it. And even if they commit to buying, then they're looking for a reason to not pay much. So you want to give them reasons to want it even more and wanting to pay even more. That's your job.
We happen to have a number of construction companies in the room. I heard about a large general contractor that got acquired out of this market recently, and was surprised to learn that they really didn't have employment agreements with their senior people, which I just can't. I find that mind-boggling.
Yeah.
And several of them have walked out the door in the recent past. Is that? I mean, we have employment agreements in our business. It's pretty standard, and they include non-compete, confidentiality, non-solicitation of employees and clients. Certainly I feel like it's less common in construction, but I mean, I just can't imagine selling a business that's basically a management group and not having folks tied up. I mean, has anybody got key person agreements in place?
Well, and I'll just say I was with the company last week, 80 employees, 0 employment agreements. It's but this is easy to do, guys. I mean, if you don't have them, get them. You can get them by year end. It's a good year end planning thing, and year end bonus. And here's in exchange for a bonus, here's this. You got to sign this agreement. But yeah, have employment agreements. That's a key point. More about this personal and enterprise goodwill. On advertising, if it's your name, like my business is Adams Capital, wasn't really thinking about this when I started the firm, but people want to call me. I want them to call, our main number and be happy with my team, who I would argue will do a much better job for you than me. If you want me to enter all the stuff in the spreadsheet, it's going to cost more. It's not going to be as good. And I'm guessing the same would apply to each one of your businesses. If I want you to personally build the building, you're like, wait. No, I got a team that builds the building. So my job is to have the team. Repeat customers, do they come back because of me, or do they come back because they got great service from the team? Organizational structure, think about McDonald's. We don't go to McDonald's because Betty works the cash register. We go to McDonald's because it's a Quarter Pounder or Big Mac or French fries. Big difference for enterprise. And management depth. If you we had a client years ago, their whole management team was on an airplane. The airplane went down, and it destroyed the company. They ended up having to sell. But if that same thing happened at Coca-Cola or IBM, Apple, it didn't, Google, there's more plane loads of, executives. It wouldn't even miss a beat. You would never really know unless you were personal friends with those people. The business would continue. So we want to move towards enterprise. Discounts for lack of marketability. Basically, because you're here, you're not marketable. If you were on the New York Stock Exchange, you could sell your shares and get cash right away. That's the definition of marketability, because you have to go through, hire an investment banker, go through this process to sell a business. It's not marketable, and there's a discount. If you will, if I'm comparing you to the stock exchange company, you're discounted maybe 20, 30% because of the cost and uncertainty of this process. And then lack of control. If I own less than 50%, if I can't vote the stock, it's worth less than whole. So if you have multiple owners, one of the first things I'd recommend doing is going to the owners if you're thinking about selling and getting everybody to enter into a binding legal agreement that if I can reach a certain threshold price, that they'll sell. Because the last thing you want is if you've got an equity agreement that says any shareholder can block a transaction, which is a pretty normal term. You've got that 5% guy that's blocking your $100 million transaction, and they want more money. It's not a good time to find that out. You want to lock them up legally in advance so that when it's closing, you can close. Let's see. Management control here. Passage of time, we're not in control of that. Market valuation multiples, we can't do anything about that. Market interest rates, not our business. We got to react to it. On the other end, the way the management's organized, the employment agreements, the relationship with customers, with suppliers, All of these things are absolutely under management control. This is what you're graded on. Focus on this stuff you can do and don't worry about what's out of your hands. I mean, you need to be paying attention to it. So maybe don't worry about it might not be exactly the right term, but you can't do anything about it. Plan about what you can do. But the element of control here is something to be managed within organizations as you add people. Who's in charge? Who makes a decision? Yes, question.
Yeah, question on privately held small LLC type firms. What's your feeling on an advisory board? No voting right, but to help with the management control, the direction, kind of helping you stay between the white lines.
Yeah. So thoughts on advisory board? I think the concept of an advisory board, I think, makes a lot of sense. Peer group, whatever, but somebody to keep you sort of on track and help you as an entrepreneur run the business better. Big fan of that. You need to understand the commitment of your advisors. And I see companies that have, advisory boards, and they meet with them every quarter. But they're country club kind of advisors. They've never really studied the financials of the company. They don't know the industry. It's a presentation to friends about how you're doing, and they slap you on the back and say good. I think another level of advisory board is that board that's really digging into, well, wait a minute, what's going on with this financial statement? Why are margins slipping in this area? Why are we paying that, consulting firm that much money? Is that something we should hire somebody in-house for? But you need a financial operational skill set that can really act and help you make the next big decision. So I might think of advisory boards as a little more of problem solving. If I were going to create one, tell me what you're struggling with, what's holding you back, and let's bring in professionals who've been there, know that, have them work with you for a month or two, solve that problem, and then of course, they'd be available if you had another issue, but then they go away. But there are different ways to do it. But I like advisors who are more connected, have studied the business. And frequently, when we get involved in a business valuation, our business valuation process is really digging into the financials and understanding the business and the operations. That's usually the first time anybody's done that. And we uncover a lot of good stuff. One client, we found $3 million a year in loss they were unaware of. They had a CFO, and that CFO was just booking it, following the rules, the accounting rules, but not really looking at it from an operational perspective. We just shut that down, and that family made $3 million more a year. Another case, we're valuing a business, a trucking company. And let's just say, you could go to the office and they made, it was cheap. It was low-end used furniture. They were bare bones. And I kept looking at, they're paying market prices for fuel, market prices for trucks. They're paying market salaries for their drivers. And so all their expenses to me seem market. And yet their margin was well under industry. And we went back to them and said, I think your revenue is too low. You need to raise your prices. And they're like, oh, our customers are always fighting us over raising prices. We can't raise our prices. I'm like, well, that may be true, but our analysis shows that there's something wrong with your financials, and it looks like revenue is the thing you need to be working on. Well, they studied it, ended up raising their prices an extra $10 million a year in their pocket. They had one customer leave. And so, you know, I don't know that the advisors, unless they're really digging into the numbers, can find these kinds of things. Okay.
David, how much of your work is that kind of consulting work versus just a strict valuation?
Yeah, about the majority of our work is now more consulting on building value, in fact, good lead in to the next slide, Hunter. But really, it's just all about creating a better business. If you've got a better business, it's going to be worth more. But you want to increase your profitability, decrease risk, increase your growth, shift your personal goodwill to enterprise goodwill, and other things that we see that become valuable in the market are sustainable competitive advantage. You know, what makes you unique and different from the competitors? Transparency. I mean, not only do you have it documented, but you've got it at your fingertips. Whatever question they ask about your operations, you go, I got it. Here you go. Let me share this document. We got a report on that. If you can do that in any, not necessarily you, but you've got a person in your organization who can just spit out all that information and keep doing their day job, that's awesome. Let's see. Document your processes, procedures, budgets, plans. And these are the things that you need to have in place. You think everybody is supposed to do it your way. I promise you, if I meet with the top person of an organization and they tell me how the business is supposed to run, and then I go shop the store, when I shop the store, the experience is different than what the top person told me it was supposed to be. So it's documentation and training, written plans, contracts. So thank you very much. Pleasure to be here. Happy to answer any questions.
I just want to say, I mean, one of the reasons we wanted to do this program is we here at our firm have had an annual appraisal done every year since we started, and we have no intention of selling the firm. And couldn't agree more with all the insights he's been providing. That process and that information and the metrics that you are tied back to, because these guys have data, and you know, they're basically looking at what the relevant metrics for your industry. There's just so much value that comes out of that, and we hold it to be very transparent. We actually trade our stock based on this annual valuation. So, you know, it gets all my partners and I rowing in the same direction. And, you know, I agree 100% with the point he's making, is that it's just made us a better business because we're accountable to best in class performance metrics. And if we're not achieving them, my partners are saying, why the heck aren't we? And what are we doing about it? And I just think that's invaluable to any business. I think we have the same philosophy that David espouses, which is we always look like we're preparing to sell it. We're not, and we're not at all. It's actually the opposite. We're just trying to run it cleanly and the best we can, and you know, with a clean balance sheet, and no, you know, talk about, you know, we don't have any owners deals. I mean, everything's so transparent, but it's just really, I mean, it's like herding cats around here in so many ways. But this document, this process that we go through, has just held this group together, and I think it's been invaluable. And I know a lot of people around the table have got partners, they're thinking about taking on partners, thinking about selling the business, their management team. I'm a big fan of this. You'll get a lot of value out of it. Even if you don't decide to do it every year, if it's something where you say, we're going to do this every 2 or 3 years, I would highly encourage you to think about having one done, because it's just the value you get back is multiples of what you spend on it. But having said that, we appreciate everybody coming out. We've got another program scheduled for November 6th. We've got Al Clark, a partner at Smith Adcock, well-known speaker around the construction industry, kind of self-described tax geek. He's going to come in and talk to us a little bit about the changes that are coming down the line on financial reporting for construction companies. So there's some revenue changes that are going to be mandated soon, I think next year. Also lease accounting and some things like that. If you're, if it's not something that falls into your bailiwick, but you got somebody on your team that would benefit, please, forward the invitation. We have no pride of ownership of the invitation. We're happy to have you direct it to anybody on your team. But thanks for coming through the weather. It looks like we're clearing up, and have a great day.
Thank you, Doug. I've got a handout here on personal and enterprise goodwill. If anybody like one, pick it up on the way out. Thanks, Skip.
Excellent. And